All right, what the heck happened today? The Fed finally gave us the rate cut we've all been waiting for, right? I mean, it gave us exactly when. What happens? Well, the market just implodes. Dow plunging 334 points. S&P plummeting 1.09%. NASDAQ nosediving 1.19%, huh? Honestly, there was nothing shocking about Fed Chief Jay Powell's statement, but a lot of people don't seem to understand how the game is played. Powell told us this rate cut was basically insurance and not the start of a new easing cycle. That upset everyone who was hoping he'd say, well, we're going to get a lot of rate cuts galore, including those betting the dollar would decline. It didn't. But that's not what happens, people. The Fed is supposed to be cagey about this stuff. That's kind of their job. Remember the last time Powell told us his long-term plans in October? Well, the stock market crashed. Promising a series of rate hikes was a big mistake. He's not going to make the same mistake here by promising a series of rate cuts. He's not stupid. Of course, President Trump piled on about how Powell let us down. But remember, you can easily say that Trump let us down by firing Yellen, who is much closer ideologically to Trump, and then putting Powell in. Enough Powell bashing, for heaven's sakes. He's now on the case, even as there's plenty of evidence, positive news, enough to befuddle some of these Fed watchers that maybe he shouldn't cut at all. You know my view. It was time. Got to roll back that cut. I mean, that increase. And yes, I do want another if things falter, okay? That December one, you know, I didn't like that. But a lot of people do not understand how things work. So calm buyers turned panic sellers in rapid fashion, and then the whole market got slammed. And you know what? That's a good thing. It lets you buy the stocks of high-quality companies at a discount when people were just throwing them away because of fear. A lot of people were selling stuff they didn't even know what they were selling, for heaven's sakes. Consider the biggest winners from this incredible month of July instead of being so crying in your beer here. Many of them are down today. When you look at these leaders, you don't find many companies that rally in anticipation of a rate cut, I'll tell you that. No, you see a list of companies that shine because of good execution and strong demand. The ones that don't need the Fed are absolutely worth buying into this weakness. Let's start with the biggest winners in the Dow Jones Industrial Average, and then we'll move on to the S&P 500. The best performer in the Dow this month was a stock that leapfrogged over its peers because it reported a terrific quarter yesterday, Procter & Gamble. It's up 7.7%. This is that rare story where conviction trumped discipline. On Monday, I was on Halftime Report where Melissa Lee was hosting. She asked me point blank whether you should buy the stock ahead of the quarter. I talked glowingly about the turnaround, how well CEO David Taylor's doing at the helm. But then I warned you not to chase because the stock had rallied so hard into the print. Then yesterday, Procter delivered some spectacular organic sales growth, up 7%. That's staggering for such an old-fashioned consumer packaged goods company that had been struggling to put up low single-digit numbers for ages. We would have been happy with 4%, for heaven's sake. Every category looked good, including the ones intractable ones like grooming, which have really hurt them. Turns out Procter deserved to run. The thing went from a blue-chip dividend play to a growth stock literally overnight, a senior growth stock, not unlike Starbucks. We're seeing a lot of these. Next up, here's another stock that roared in the wake of good quarter. Of course, Apple. It's up 7.6% for July. I'll have more to say on this one later, but it soared today because it posted a quarter with growth all over the place. Apple now has a more consistent, sticky revenue stream thanks to its subscription-based services business. And when you combine that with the strength of the wearables, it's become the real driver of the stock. Now, buyers don't care that much about the iPhone sales disappointing because the wearables and the services are the future. Investors always pay up for more stocks with recurring revenue. Tim Cook's Apple's making that transition, like he would ever get credit for it. While it doesn't deserve the same price-to-earnings multiple as the aforementioned Procter & Gamble, which, by the way, would put this $213 stock at $280, I think the valuation is too low. And Apple should be trading more like a consumer packaged goods company or a cable company, not a plain old hardware company. When you judge it by the same metrics as those in the industry, say by measuring the lifetime value of a subscriber to Apple's burgeoning paywall offerings, it's clear the stock is way too cheap. I say, own it, don't trade it. Next month, Apple launches, well, it's like tomorrow, a new credit card with the help of the third best performer in the Dow, Goldman Sachs, also up 7.6%. Goldman's pivoting toward more of a recurring revenue model, too, which is what the market really wants. The stock's been rallying like mad because investors love fee-based businesses and not episodic trading-based earnings. I think it deserves to sell at an even higher valuation. Gigantic buyback will help them get there. I just hope Goldman's ready for the Apple charge card. The fourth best performer in the Dow is a real blast for the past. IBM, it's up 7.5%. Some of the buoyancy is just the stock bouncing back from a very low level, compressed by last year's mini bear market, PAL bear market. But most of it is the beginning of a beautiful friendship. IBM closed on its acquisition of Red Hat, and that could spark a return to growth and excitement for this once moribund stock. I think the run makes sense. And even up here, it still has a 4.3% yield. I'd be a buyer. Finally, here's a total oddity, Intel. The company didn't really do much to deserve a rally this month. It was strictly a BTF situation, better than feared. Speaking of chip makers, by the way, I like competitor AMD on its hideous 10% dip today relative to the company's lighter guidance, something you should have expected, but still it managed to shock people into selling.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.